Alright, so moving on, I want to share with you a few common stock trading terminologies that you'll probably, come across. So if you understand what these means, right, then hey, you can just move on, right, and don't have to watch this video. But if you have no idea, you're clueless, then hey, pay attention. This is important. First thing first, what is long and short? So when you hear traders, say that, hey, I'm long or I'm short, it simply means the direction of the trade that they are taking. Right? When someone says he's long, it means that he will make a profit when the stock price goes up. So for example, let's say someone says, I'm long Apple shares at $100. It means he buy Apple shares at $100, and if Apple shares goes up to $120, he makes a profit of $20 per share. So that is what you mean by going long. On the other hand, right, when a trader says that I'm short, it means that he will make a profit if the stock price goes down. So how does this work? So when a trader is short, what actually happens is that he will borrow shares from the broker. So let's say, I'm short Apple shares at $100. So I'm going to borrow $100 worth of share from my broker. Okay, I will borrow this $100 worth of share. And let's say the stock price of Apple goes down, right? Let's say it drops down to $90. Okay, so what will happen is that since I borrowed this $100 worth of share, I need to return back, right, the share of Apple, because I borrowed one share of Apple. Now I need to return back this one share. So let's say I buy this one share of Apple at the open market for $90 and I return it back to my broker. So in this case, or in this example, you can see that after the transaction is completed, I borrow the shares and I return back the share. At the end of the day, I made a profit of $10 per share. Okay, so this is how short selling works, right? You borrow the shares, you sell it at the market, you collect the proceeds, although you won't really see it, right? Because the broker will manage all this transaction, right? And once you buy back the shares and return it back to your broker, you will then collect the difference. And in this case, since the stock price goes down, right, you make a profit of $10. But what if, right, the stock price goes up? It moves against you, right? Then the loss, right, will be I'll explain, right? Let's say you short $100 worth of Apple shares and it moves up to $200. This means, right, you collect $100 upfront by borrowing the shares of Apple, and then when you need to pay back the shares of Apple, you buy it at the open market for $200. So you can see that this is a loss of $100 to you because the price of the stock went against you. It went up higher. So one thing about short selling is that your losses is technically unlimited, because what if the share price of Apple moves up to $500, $1,000, $10,000? You can see that your losses can exceed, right, even your initial deposit. So short selling is it's not very common compared to traders who are usually long, but there is this so-called feature available, right? Your broker might offer it. So again, if you want to dive deeper into short selling, this is something that you have to know. Okay, so with that said, moving on, what is a bid and an ask? So when you are dealing in stock trading or futures trading, right, you will see that a price, there's no one price in the market. There's always two prices. Well, in fact, there can be more, right? But basically, there are two key prices that you have to pay attention to: the bid and the ask. So what this means is that the bid, right? If you wanna, let's talk about the ask first, right? The ask is simply, right, let's say you want to buy a stock right now, okay? You have to look at the ask price, because that is the price that you have to pay if you want to buy the stock right now. And on the other hand, if you want to sell the stock right now, you will pay attention to the bid price, right? This is the price that you can sell right now. Okay, so there's always two prices in the market, all right? The ask price and the bid price. The ask price is the price that if you want to buy the stock, that's the price you have to pay. The bid price is the price that you can sell right now if you want to sell a stock. So this is what we mean by the bid and the ask. So what is the spread, right? The spread is simply means, right, the difference between the bid and the ask. So let me share with you an example. So let's say again, Apple stocks, right? That's the easiest to talk about, right? Let's say Apple has the asking price of $100.20. That's the ask price, okay? And the bid price is $100.10, for example. So the spread, right, of Apple right now is 10 cents, right? The difference between the ask and the bid. And that, to you, my friend, right, is a transaction cost to you. This is a cost that you have to incur. Okay? Because right now, if you think about this, if I buy Apple shares right now, I'm going to pay $100.20. And let's say the stock price didn't move, and I want to sell it immediately, I can only sell it at $100.10. That is an immediate loss of 10 cents to you, and that is the spread that you have to pay. And this is not even taking into consideration your commissions or fees to the exchange, etc. This is just the so-called the bid-ask spread, a transaction cost that is borne by you, the trader. Okay, and one thing to note is that Large cap stocks, right, they are typically more liquid. So this means that you can expect a tighter bid-ask spread. So for example, let's say, I'm just giving a hypothetical example again, say Apple, it's a large cap stock, right? So the spread over here, what I share with you is, let's say, $100.20 is the ask, and $100.10 is the bid. So this is the ask, this is the bid. And your bid-ask spread is 10 cents. A large cap stocks, right, they are usually more liquid, you have a tighter bid-ask spread. But let's say you deal with a small cap stock. They are usually less liquid and you can expect a larger bid-ask spread. And this would be, right, a higher transaction cost to you. So for example, a stock of, let's say, $5.50, right? This is the ask, an example. And the bid is $5. So you can see that the bid-ask spread now is 50 cents. And you have to, realize that the more you trade these stocks, right, buying and selling, right, you have to pay a larger bid-ask spread, and that will eat up into your returns. So this is something that you must know, okay? Usually the larger cap stocks, they are more liquid, the tighter the bid-ask spread. And when you're trading smaller cap stocks, right, they are less liquid and the bid-ask spread tends to be wider. And the reason is being because there's just lesser people trading the smaller cap stocks. So this is why, it's not as liquid, there are less orders in the market, and that's why the spread tends to widen. Alright, so with that said, let's do a super quick recap. Number one, you've learned what is long and short. It simply means, right, what is your trading direction. Number two, what is the bid and ask? The bid is the price that you can sell at right now. The ask is the price that you can buy at right now. And finally, we talk about the spread, right? What is the bid-ask spread and how large cap stocks, right, tend to have a tighter spread, and less liquid stocks, like small cap stocks, right, their spread tends to be wider. Okay?